A very good afternoon, good morning. Welcome to HYCM's workshop. A very warm welcome to you. Hi, Brian, Gavin, Kashi, good to have you here. Gavin, I will be replying to your email. It's on my to-do list. I've been a bit hectic, so I'm sorry to have not replied as quickly as I normally do to your email, but I haven't forgotten you. It's on my list to do. Been particularly busy as I'm trying to get as much done as I can before heading off for Christmas, so apologies to you for that. Gavin, everyone else, welcome, good to have you here, and looking forward to the session, the Bank of Canada interest rate decision. It's potentially a good one, so well worth looking at. If you can just let me know you can see my screen and hear my good afternoon, Brian, good to see you. If you just let me know you can see my screen and hear my voice, okay. Don't forget, as we look through different entries, exits, the whole idea of this webinar is from an educational perspective, so you can see how I'm going about understanding the market, knowing what my expectations are for the moves in the various instruments, but particularly in this case in the CAD denominated currencies, and we'll be looking forward to getting us ready for that. Yeah, thank you, Brian, loud and clear, excellent. Other folks who've just coming in. Course today we're looking at trading the Bank of Canada rate meeting. Also, thank you for those who have borne with the change we've had in the webinar. There was a problem in the back end and I think that should be sorted now, so good to see some regular faces turning up again. I think we had a problem with registering the webinars at one stage and there's been a bit of a shift, so well done for getting through that hurdle and apologies for the inconvenience. Remember the whole principle of what we're doing when we're trading. We're looking to back strength against weakness. We want to find a strong currency to trade it against the weak currency in order to give us a high probability anticipation of direction. That's the whole purpose of the fundamental outlook with these trading workshops. We're looking to trade strength against weakness in the same way that we have a strong arm and we'd expect that to beat the weak arm. We're looking for reasons for a strong currency and to pair it against either a neutral or a weak currency pair. So without further ado, let's get stuck into the session now. It's the Bank of Canada interest rate decision coming up later this afternoon. Now, the last interest rate decision that the Bank of Canada took was a more dovish path than kind of markets have been really necessarily anticipating, though we had been anticipating it at the time. And for those of you who are following this carefully, and we've been anticipating a bit of a slowdown starting to come in the Canadian dollar. The Canadian dollar had a lot of strength, gaining and gaining and gaining, and we were expecting a slowdown in the path of rates. And that's exactly what happened at the last interest rate decision. The Bank of Canada, they only hiked by 50 basis points. There'd been a split in money markets, whether it be 50 or 75. It was only 50 basis points. And this was the key bit. They flagged some concerns about slowing growth, which weighed on the CAD in the immediate aftermath. So it's things like the rising interest rates were dampening demand in the housing sector. The fact that the US, they were expecting that to go into a recession. And if you just have a look at the interest rate decision here, you can see they're expecting the economic activity to slow in the US, and they're expecting no growth in the US economy through most of next year. And we know that the Fed see the US economy base case as being in a recessionary economy. And remember that the US is Canada's biggest trading partner, which makes sense with the US and Canada sharing a border, being so close to each other. So a slowdown in the US would necessarily impact the outlook for Canada in a similar way that a slowdown in China impacts the Australian dollar, because the two economies are so closely connected. Similarly, the Bank of Canada just seeing a general global slowdown. Remember, it's not an even economic world. The US is by far and away the largest contributor to global GDP. When the US is struggling, as a general rule, the rest of the world struggles with it. So about a quarter of all the world's GDP comes from the US alone. So with the US struggling, and China's economy had been struggling with those ongoing challenges, basically its property market and COVID, the pandemic lockdowns. Remember, at the time that Canada did this, October 26th, China went a little bit more restrictive. Between China and US, that's nearly 50% of the world's GDP. So you quite quickly see that there's three big players in the world, really. That's the US, the Eurozone, and China. So what's going on in Europe, what's going on in the US, and what goes in China is very important. And you can see that's why those three areas are mentioned by the Bank of Canada. It's the US, Europe, China. And what they're saying is generally we're looking at slowing global growth from 3% to about 1.5% in 2023, and then picking back up. So a slower pace of growth. So what the Bank of Canada is saying is we're expecting a slower pace of growth, and we're expecting a slower pace of global growth. So all of this means that, yes, inflation remains high. The expectations of the Bank of Canada will have to continue to hike interest rates, but there's a little bit of a dip in the aggressive kind of outlook we had been seeing from the Bank of Canada. So, that was the legitimate question. Is the dollar index going to fall from here? And the most obvious reasonable answer is yes. It's a more dovish stance from the Bank of Canada and should allow the CAD to weaken somewhat over the medium term. So that was the prior meeting. Now, if we take a look at the Canadian dollar as an index, you can see that the Canadian dollar has fallen from those index highs, okay? And it's really been quite pronounced. One of the contributors to these falls has also been the drop in oil price. There's a pretty close correlation between the Canadian dollar and oil prices. And if you just, we overlay oil prices, you see that that correlation is quite tight. When oil prices drop, CAD drops. When oil prices rise, CAD tends to benefit with it. So rising oil boosts the CAD, falling oil weakens the CAD. So those twin factors, as we've had a number of different, quite varied drivers in the oil markets, but that's just been pushing the CAD lower. So what's our base case? Well, the base case is this. The Canadian dollar has already weakened somewhat from its previous elevated position. So that selling bias has been pricing in a slower path of interest rate expectations moving forward that's generally been priced into the CAD. So the best opportunity is going to come here if the Bank of Canada is more hawkish than the market's expecting. We just take a look at expectations, looking here at the financial source team, looking at their very helpful short-term interest rate market projections and the outlook for the terminal rate for the Bank of Canada. You can see that at the moment, the implied interest rate peak is around 4.40%, okay, just under 4.40%, around the summer of next year. That's where interest rates are expected to peak from. The current rate is 3.75. Now, the expectations are for a 25 basis point rate hike today, but it's a bit of a mixed picture. And if you just take a look at, let's just put Canada on this block. If you just take a look here at the interest rate decision, 3 o'clock UK time, you can see that most interest rate expectations from economists are for a 25 basis point rate hike. It's currently 3.75, and the expectations is that it's going to move up to 4%. Now, the high expectations is 4.25%. So there are some economists, and it's roughly split, who are expecting a 50 basis point rate hike. But if you look at the expectations, you can see that money markets are pricing in a 65% chance of a 25 basis point rate hike and only 35% chance roughly of a 50 basis point rate hike. So this tells us that the market is skewed towards expecting a 25 basis point rate hike on balance. Okay, that's the expectations, and money markets tend to be the ones that are most likely to react to a shift from their expectations. Economists can, so my daughter had an interview with Cambridge University this week, and one of the ways the interviewers introduced themselves was, hello, I wrote a book titled Why I Hate Economists. And, talk about a way of introducing yourself, quite funny, but the title of the book, obviously I haven't read the book, but it's this idea, isn't it, that economists can be somewhat detached from society and some of the financial implications of the pure abstract economical theory versus what happens in practice. So what that means for us is that the economist projections are likely to have less impact than what's happening with the money markets projections, because these are people who are invested in the market. The economists, they're more looking at it slightly more abstract, one step removed. So, you know, if they change their forecast, okay, fine. But these folks might be changing their portfolio and their CAD positioning as a result. So the bias is for a 25 basis point rate hike. Now, what that means is if we get the 50 basis point rate hike, then that will be the surprise. Okay, so 50 basis point behind, but we need to see a bit more than just a 50 basis point rate hike. Because what we also need to see is we need to see expectations that the Bank of Canada is expecting to be more hawkish. So we want to see a 50 basis point rate hike, and we want to see that terminal rate moving higher. So if the Bank of Canada, for instance, said we've hiked by 50 basis points today to control surging inflation, and we are expecting the terminal rate to be higher than we previously did, that would be a hawkish decision. Now, if you look at the latest kind of data we've had from Canada, it hasn't been too bad, really. So we've had some the inflation readings were high in the middle of November, 5.8% for the core versus 5.6% expected, 5.3 for the trim mean, 4.8 for the CPI median. So strong inflation, yet the headline in line with expectations, but strong inflationary print. We've had purchase price index fairly strong, so inflation is remaining elevated. We've got GDP growth rate strong, unemployment way below minimum expectations, 5.1%, and below the forecast of 5.3. So that's a strong labour market. Full-time employment above the minus 30,000 expected, robust, and hourly wages 5.4%. Remember how the Fed will be concerned by those strong non-farm payroll wages we got last Friday. Higher wages is a great fear of central banks because it can mean a wage price spiral gets underway. The Bank of England, Governor Bailey, hiked interest rates, one of the first central banks to hike interest rates in the UK because he feared a wage price spiral. He had a widely criticised speech as he tried to encourage people not to ask for a pay rise because he was trying to fight this wage price spiral. That, of course, was misunderstood and perceived that he was being sort of elitist and privileged and trying to oppress people. And actually, he was just trying to keep a wage price spiral out of the UK economy. Remember the RBA, they've just met. They're concerned about a wage price spiral. We've had non-farm payrolls. The Fed watcher, WSJ Tim Rayo, said that will concern the Fed, make the Fed more likely to hike more aggressively next year. So average hourly wages, that's more likely to concern the Bank of Canada too. It's on central banks' radars, okay? High wages is a concern. What they want to see is they want to see evidence of cooling demand, and they want to see it in the labour market. Once you see demand cooling in the labour market, it means that the impact of your hiking interest rates is starting to work, because it means you're hiring less employees, you're offering those employees less pay. What are you going to start to do? You're going to start to cut prices because you're starting to see a cooling in demand. The trade balance, pretty good, exports, imports, and the general outlook for the Canadian economy, has been fairly robust. Now, what that means is there is a chance of a hawkish bias, but what we want to see, one, the 50 basis point rate hike, okay, and two, we want to see a comment like in the statement, something like, the Bank of Canada increased its target rate to 4.25%, and the bank is expecting to hike interest rates at a faster pace now due to XYZ. That's the hawkish response. So if they just hike by 50 basis points, but they continue to stress slowing growth, you could see that being faded. In other words, the CAD suddenly strengthens and then quickly fades. So the best opportunity, and that's because you see all this CAD weakness we've had. Now, we expected that out of the last decision, And you can see here the last decision was October the 26th. So we had that October 26th decision, and we've just seen the CAD, weaken, from that decision. Okay, made sense. We've seen that weakness. It's carried on. Now, the best currency pair probably is something like the pound CAD short on a hawkish decision. There are some other options, and we'll go through them. So you can see the pound has continued to move higher, and if you remember at the last decision, an obvious sort of pair to see some of that CAD weakness express itself would be for this 1.5900 area on the daily chart, and you can see that that broke out very nicely, got that 1.5900 area, and price just sort of has pushed higher through that region, and you can see that October 26th, this was the area to see price go through, and it's just sort of crunched through that area and made its way higher. All of that, made sense. Now, the stretch we've seen in this CAD weakness, if all of a sudden we see reasons for hawkishness from the Bank of Canada, then we'd expect a sharp unwind in this price. So how can we go about potentially managing risk? So first of all, from a swing trading perspective, risk can be easily managed just at this point here. Okay, we have here an obvious place to take profit. All support turns into resistance. We're at a massive resistance level, and stops can be placed very tightly just above that 1.6760 region. Okay, so if there's a hawkish Bank of Canada and we're expecting a little bit of a shift from them, then you could look at potentially shorting here with stops very tight, just about that 1.67 region. And then the price can be managed on a swing trading perspective using some trend lines to manage and define the risk. So it would be just using this very tight trend line here. I would just pull that out a little bit. And you can use this trend line. Now, that's not strictly speaking, that's not a trend line from a technical perspective, but in my experience, that's good enough. It's just this swing point here would be a decent enough reference point, and then that would most likely become a reference point moving forward. So a break below that line, stay below that line to stay with it, get back above that line, make sure when you draw it, you extend it out, get back above that line and exit the trade. Okay, very simple, would make a lot of sense. But that would be in the scenario 1, you get a hawkish Bank of Canada. 2, they've hiked by 50 basis points. 3, the terminal rate has moved higher. That's what we look for. Could also, as an alternative to the pound CAD, look at something like the New Zealand dollar CAD. That would be legitimate. And again, you could use exactly the same approach. Using a trend line just drawn across the latest swing points, and just see if there's anything there that's technically looking. Yeah, again, what you could do is you could just sell at market and just price above the recent highs. I'll probably use like use the R2 pivot point and just above the 8.700 region. So it stops just above 8.710, something like that. That should be good enough. Now, I have to stress that's the best opportunity, and the reason that's the best opportunity is because, like, we've already seen quite a lot of weakness in the CAD. Yeah, that CAD weakness, you see now. So that means if there's a bearish response,
from China, Sinopec's Yangtze PC has shut the #1 cracker following a fire.
I don't really want to see, that all that CAD weakness. That's a lot of this being priced in. Okay, so this slowdown in growth that the Bank of Canada said from October, a lot of that's being priced in. So if they're dovish again, they'd have to be really quite dovish for there to be more CAD weakness. So what kind of dovishness would we expect? So we'd expect, if it was very dovish, you'd want to see that terminal rate sort of drop below 4. You'd want to see like maybe either a 25 basis point hike or on hold. And if they were on hold and they projected lower interest rate peak, and we started to see interest rate expectations dropping, and if they said something like, we're not hiking today because we're seeing evidence of cooling demand and we want to give ourselves the next flexibility, and we anticipate interest rates peaking at a lower terminal rate than prior. Now that would likely result in CAD weakness, and probably the go-to pair would be the CAD yen, and it would be a CAD yen sell. But you'll see like there has been weakness in the CAD, but this little bit of a bounce in the CAD yen maybe gives us an opportunity, and again it will be just defining risk above those near-term highs, using this as a kind of mini symmetrical triangle breakout pattern. Okay, so it'd be just using price like that. And if you drop down to the 4 hours, you'll see it's much easier, and so it'd be simply selling at market with stops above the outside of the pattern. So I would say just above the R1, so like 101.17, and then looking for a move now S2 or beyond. But as I said, that's not the trade I'm looking for really. The trade I'll be looking for is the pound CAD, because that's the best opportunity in my opinion, because we've seen so much CAD weakness. If we suddenly saw the Bank of Canada change tact, pound CAD selling would make sense. Okay, folks, that is where I'm at for this. I hope that's helpful. I hope that's making sense of the decision. And I want to say, if you've got any questions, please do ask now. But otherwise, that's the basic outlook that we'll be looking at as we head into the session. Don't forget to follow my central bank pieces here on Central Bank Watch. Do a Central Bank Watch, and you can see the latest central bank decisions as they come in, and just gives you a little bit of a steer on what central banks are doing, and what anticipation that we can expect. And obviously, I can't update these every day, so the decision I make on those things, these are not trade calls or anything, but I'm just giving us what that current bias is. So yeah, good to see you, Kashif. Glad you could make it. Okay, folks, thank you all very much. Brian, good to have you. Gavin, good to have you here. Nacius, glad you could make it. Kashif, Nuno, Padma, thank you all for attending. And don't forget, I will be back here on Monday, and looking forward to getting us ready for a very busy week next week. So next week is to be on your A game, whole series of central banks called the Fed meeting, and we'll be deciding, exactly whether the Fed is going to be pausing, pivoting, or hiking even more aggressively. Everything is on the table at the moment, so quite an exciting meeting. Yeah, that's great, Kishi. Take care, everyone now. Goodbye.